When do you perhaps start to use pain as a buying opportunity? That may be today's question. It seems that we do have probably a little more pain ahead before we see stocks rebound. Here's what you need to know. It's great to have your company for the daily. My name is Jessica Amir, a market strategist here with Memo. But first, let's cover what's going on. We saw US stocks hit fresh lows overnight on concerns about the US economy. Now, the recent sell-off picked up pace inspired by fresh US consumer confidence data, which showed that confidence is now falling. It's fallen by the most since 2021. So consumers are indeed, are reflecting that they're worried about Trump causing political instability, firstly, and also causing concerns about inflation. And markets are dropping on expectations as well. The company's profits are likely to be potentially downgraded, and this has been reflected in the stock market. Now, if we have a look at the benchmark index, the Nasdaq 100, that's now down 4.8% from its Feb 19 high. The S&P 500 is down about 2.7%. We can see that here on the VOO ETF. But let's just go back to the tech stocks. Interesting to note that the Mag 7 pinup stocks are now officially in a correction, down 10%, thanks to Tesla falling about 9% overnight. They've now fallen under their $1 trillion market valuation. Now, Nvidia has also seen a very large fall. Nvidia is down 8% in 3 days. They're almost in a bear market. And remember, a bear market is a fall of 20%. So Nvidia is down 16%. And this is, of course, weighing on the QQQs. So fear may be peaking. The market's fear gauge, the VIX, spiked to a level of 20. And remember what happened last time the VIX hit 20, or markets sold off heavily. So this is the question now, how low can we go? One institutional bank overnight said that they saw the biggest US retail amount of sales in 1 hour in history. But we do have to remember that we do have the Nasdaq 100 and the S&P 500 testing their 100-day moving averages. And the last 3 times, the Nasdaq 100 and the S&P 500 fell under the 100-day moving averages. The last 3 times this happened, markets then fell for 3 to 7 days before then recovering to march on up and hit new record all-time highs. So watch for this. Basically, all I'm saying is expect a little bit more potential pain ahead before you see a rebound. So we're waiting for good news. What are the good news catalysts that could drive markets higher? Or will it be Nvidia's results, or will it be Fed commentary? Don't really know. Let's have a look at Bitcoin, and the largest Bitcoin proxy in front of us now is MicroStrategy. MicroStrategy shares have tumbled, but let's just touch on why that is. Bitcoin fell under the key 90,000 US key psychological level overnight. It's now down 8% in 3 days, or about almost 20% down, or 18% to be precise, from its record all-time high. So this, of course, is affecting MicroStrategy. MicroStrategy, the world's biggest holder of Bitcoin. MicroStrategy, as we can see, their shares are now down 23% in 3 days. MicroStrategy is in fact down much more than that since their November peak. They're down 52%, and that's wiped off $41.3 billion in market value for that stock. Now, remember this, the software company overnight said that they bought more Bitcoin. How much did they buy? They bought 20,356 Bitcoins. You guessed it. They bought that over the last several weeks. So they basically bought about $2 billion of Bitcoin, paying cash for that, for an average price of $97,514. So now MicroStrategy holds almost 500,000 Bitcoins. That's more than the US government, which holds 200,000. So you might be expecting a little bit more pain ahead if you're a technical analyst for Bitcoin and MicroStrategy before we maybe potentially see a rebound. That's something for you to consider. Let's move to the Aussie share market. The Aussie share market is facing a pressure as well, and another test today. That test comes in way of inflation data. If we see hotter than expected inflation data, that could pressure down the Aussie share market. Now, the Aussie share market is already under its 100-day moving average. And you guessed it, the last time the Aussie share market fell under its 100-day moving average. In fact, the last 3 times we did this, twice in December and once in July last year, the market then only fell for 3 to 7 days before it then recovered. Again, the common denominator here is all key markets in the US and Australia are under their 100-day moving averages, on or under, suggesting if history repeats itself, we could only see 3 to 7 days of more selling before a potential recovery. Speaking of stocks making massive recoveries, Zip is one. Their shares surged 13% yesterday, as we can see on the screen. Now, they've moved above some key technical levels that we love. That implies new buyers could enter the market here at these levels. It's all for good reason. Zip results showed that they are growing market share in the pay in 4 market. Their total transaction volume, which is what we look at as analysts for the pay in 4 buy now, pay later market, that actually jumped 40.3% year on year in the key US segment. That's outstanding, and that beat the other competitors in the market, including Affirm, Klarna, which are listed in the US. This company, Zip, also had a pretty strong January, which is promising. Also, important to note that Zip affirmed that they're expecting revenue to grow ahead and cash earnings for the year on the horizon to be about 150 million. Let's call it 147 million if you're looking for the key numbers. So they're saying that that could be I guess a lower level to expect. You might be expecting higher earnings. Also note that the Zip CEO, I thought it was really interesting that he said yesterday that they now have 4.2 million users worldwide on their platform. And many people who use Zip are actually using it as a budgeting tool to split their payments into 4. And I guess this adds to the thesis for Zip, if you believe the regulatory issues are behind it and that can continue to grow market share and revenue, then perhaps these are some key reasons why you should maybe keep your eyes on Zip, expecting higher levels and a continuation of the rebound. Meanwhile, keep your eyes on Qantas, the only healthy airline in Australia. They're expected to report pretty good results when they announce numbers tomorrow. We're expecting profits to soar and revenue growth to rise. That's if you go by what the market is saying, called consensus. So look, we can see their shares have done really well. They're up 30% from their lows that we saw in September. But do keep in mind that Qantas's earnings results last half year were a little bit weaker than expected. All I'm saying here is we may potentially see some profits taken off the table, and it may be something for you to consider. Should you be taking profits off the table just in case they report a weaker than expected result tomorrow? Speaking about who reports tomorrow, Nvidia reports tomorrow. I guess the most important thing to watch is its commentary and its outlook. We're expecting, I guess, a recovery in their chips, and we're indeed expecting to see a lot of the world's biggest companies announce that they're buying more chips. But their commentary and their outlook, if that disappoints, that'll really upset the market here. Options markets or options traders are now suggesting their shares could fall maybe 8.5%. That could be a swing lower if we see disappointing numbers. So that's probably why in aftermarket trade you might be seeing lots of profit taking in Nvidia. Thanks for your company. Have a great day.